Everything you're being told about the economy is packaged for calm, but today's tape proves that this calm is being manufactured. Now, if you own stocks, gold, crypto, funds, it doesn't matter. You need to watch this. So welcome back to your Wealth Guy. I'm Ron Halby, certified financial planner, and I dig past the headlines to show what the numbers really mean. Today, we're going to take a quick recap of last week, a real-time read on today's market action, what the gold tariff drama was really about, the crazy Nvidia AMD China revenue deal, where crypto stands in all of this, and what to watch for the rest of the week. Now, first, let's take a look at last week where we saw a classic example of headline optimism masking structural weakness. The official jobs data for July showed only 73,000 payrolls were added. This is stuff everybody already knows. This number came in far below expectations, and the Bureau of Labor Statistics report confirms the print. Now, that number, combined with the unusually large downward revisions for May and June, which changed how traders price Fed policy. Now, the markets reacted. Risk assets flirted with new fresh highs midweek and then gave up the gains on uneven macro pictures. Tech outperformed in patches thanks to AI earnings, but cyclical sectors such as industrials, materials, and energy showed a lot of cracks. Now, don't be fooled. Broad indices were supported by a small number of mega cap winners rather than a healthy breadth. Now, if we're taking a look at kind of a fast update for today, all three indices did end up finishing in the red very slightly, about 0.5% for the Dow, the S&P, and Nasdaq, down about 1/3%. All of them off a little bit of their lows here. But for traders and ETFs, SPY closed at around 635, almost 636. Now, this intraday swing roughly between 634 to about 639. That is a technical warning. When price grinds like that just below record levels, any surprise headline can actually trigger an aggressive rotation. Now, if we take a look at sector flow today, tech softened, industrial slid, while defensive parts of the market actually outperformed, but modestly. Now, that's a classic risk-off footnote when macro uncertainty actually starts to rise. But let's take a look at this gold story, where policy actually became price. See, last week, customs notice and media reports actually sparked a gold squeeze. Some futures briefly raced to new all-time highs. Then today, President Trump's announcement clarified that gold imports will not be subject to tariffs. And you can expect that the bullion markets actually breathed a sigh of relief, but gold prices absolutely got hammered. The tariff scare pushed headline flows into bullion, but the clarification pulled it far back. Now, this policy-driven volatility was not pure demand shock. So definitely numbers being pushed around here. Now, gold futures were trading in the mid 3,400s earlier in the week, last week, before today's drop, which was about 2.5%. Now, spot action does remain fragile because supply chains as well as geopolitical risk still is out there and a major play and a major factor here. Now, let's have a look at this interesting deal with Nvidia, AMD, and the U.S. government, because this absolutely blew up markets today. Under the new U.S. arrangement, Nvidia and AMD have agreed to share 15% of certain AI chip revenue from China with the U.S. government as part of an export license approval process. That's effectively a new trade tax on sales into China, and it changes the corporate economics for these chip makers and any company dependent on Chinese revenue supply. Why it matters? Well, 2 points here. Number one, it keeps chips flowing, avoiding a worse supply shock than the ones that we've already had. Now, the issue is it also reduces the margins on one of tech's fastest growing revenue pools. That's why you saw chip and other names wobble today. The headline is short-term relief for supply, but you got long-term profit pressure, and that could play a major impact on prices. Now, crypto held up better than equities today. Bitcoin traded roughly between 117 and 119 range and pulled back modestly as macro uncertainty continued to rise. Now, institutions are showing interest, but volatility remains high. Treat crypto as a high conviction tactical exposure, not a hedge that you can set and forget. Now, here's the practical checklist. If you only want to watch one or two things this week, keep these 5 items in the back of your mind. You've got the CPI inflation prints. They'll move the Fed narrative on risk assets instantly. It's important to note that higher than expected inflation equals higher permanency risk. Now, retail sales and consumer data. If consumers slow, cyclicals and discretionary risk gap widens. Any follow-up from the White House on trade tariff policies. Even clarifications or letters to customs can cause spikes in metals and affected areas and sectors. So definitely keep an eye there, because what we just saw happen with gold could very likely happen with another sector. Now, chip and AI earnings and updates. Watch for guidance from Nvidia and AMD and Intel. Revenue share announcements or license clarifications will change forward margins. Now, Bitcoin, crypto liquidity events, large inflows, or minor stress events can create volatile moves. Just keep trading tight right now. Now, actionable rules in all of this. Trim positions that rely on broad positive macro momentum. If you're long, tighten your protective stops. If you want exposure to safe haven trade, well, favor staged entries into bullion or metals-backed products rather than lump sum buys at the headline spikes. That way you're leveling out your purchases. Now, the bottom line is the headline markets look calm, but policy moves and data revisions are creating structural uncertainty here. It's well beneath the surface. Job revisions, weak payrolls, changed Fed odds, gold spikes, and retraces show how fragile price discovery is when governments step in, and the chip deal with China reprices tech margins here. Now, today's reality is what it is, but protect capital, stay nimble, and watch those levels that I've already flagged. If you want more up-to-date data, keep an eye on the shorts, where we'll be able to bring this down into a tighter package for you on a more frequent basis, but also keep an eye on our weekly follow-ups. Hit that subscribe button, and I'll see you tomorrow at the opening bell.